tell you in advance, we want audience participation. We're here to have a conversation with you, not really a conversation with ourselves. So while you're thinking about those good questions, we're going to start this off. Thank you for being here. We're going to start this off. And why don't we do quick introductions? We're going to do pass the mic until we get more. We're going to do quick introductions. We're going to do some Q&A amongst our panel, and then warm you up and hopefully get to your questions. So for me, Anthony Caniglio, CEO of Elite Capital Partners, sale-leaseback REIT, traded on the OTC under the ticker NLCP. We own 31 properties across 12 states with 13 tenants.
Hey everybody, this is Steve Burns here from Chicago Atlantic. Sorry, just one contestant. Chicago Atlantic, we are a credit-oriented platform that invests where risk is fundamentally mispriced. We've deployed over $2 billion in the U.S. cannabis plant-touching space. We're publicly traded on the NASDAQ and have a series of vehicles that allow us to invest across the capital stack.
I'm Joe Lusberg. Mike Preston. I'm Joe Lusberg, CEO and managing partner of Upwise Capital. Upwise is a full-service debt financing marketplace for cannabis operators. We have about 100 lenders on our platform, some of these guys and many others. So we do everything from construction, equipment, real estate, line of credit, term loan, working capital, inventory. Really, we work with small operators to larger operators that are growing until they get up to speed.
Hi everybody, I'm Samantha White from Feuerstein Kulik. I'm a debt finance lawyer and I run our firm's debt finance practice. Feuerstein Kulik is a boutique law firm. We're based in New York City, but we service clients all over the country in all aspects of the cannabis industry.
What's up, everyone? This is Mike Villapiano, Director at More Capital. We're a cash flow focused lender, and kind of all we mean by that is we're going to pay back off the cash flows of the business. Put about $500 million to work across the country. If you want to talk later, come say what's up.
Come back down here. All right, so we'll set this conversation. One of you are going to take this question. So let's see whose hand goes up first. Let's talk about what exactly is the cost of capital. How do you think about cost of capital? And why is it important to this industry, this discussion? Who's taking it? Yeah.
So cost of capital to us is basically what we can go out and convince family offices to invest in our funds at. Basically, there's a lot of multifamily deals out there where the risk premium's priced at about like mid-teens. We got to, I guess, incentivize the family offices to put money to work in the space, and we got to give a little bit of premium above that in order to put money to work and them to be proud of their investments. So when we're talking about cost of capital, it's basically how do you incentivize people to come into the space and leave the traditional multifamily, whatever, private equity funds, whatever deals are out there to take a walk in cannabis. And that's kind of how we think of it. It's not like any science to it, more of an art, and each investor has a different return that they're looking for. And hopefully if we have a match with what they're looking for, we can get their money, and that's what our cost of capital is. And we have to pass that off to our borrowers and make a spread so we can keep our lights on too.
So why don't you pick up, no, go ahead, Steve. I'm going to be like Oprah.
Yeah, just to add to that, I mean, the cost of capital in cannabis is largely a reflection of the supply and the demand of capital in the space, much like water capital tries to rise to its highest level. So a lot of it is, hey, we've got X amount of dollars that are being invested in the space and X amount of demand for those dollars, and it's our job on this stage to find the best risk-adjusted return for our investors. Right now, I mean, you're seeing debt rates in the high teens, but it's still much more affordable than equity rates. When you look at some of the recent deals like AYR and Planet 13 with some of the equity components attached, I mean, you're seeing cost of capital get higher than 60%. So this supply and demand certainly favors the investors at the moment.
Yeah. So we kind of answer cost of capital from a different perspective because we're on the borrower side trying to get money from these guys. So much different. Cost of capital to us really depends on what stage of your business what's your liquidity, what type of assets you have, and what type of product we're going to be able to finance, whether it's a real estate loan with one of them, or if you're qualified for a bank loan and you can go to a traditional bank and get a mortgage, right? So cost of capital in cannabis is extremely expensive. When these guys say mid-teens, it's much higher than that, to be completely honest with you. There's origination fees, there's warrant coverage, there's legal fees, there's exit fees, there's broker fees like mine. Yeah, but we're transparent. We tell you up front. It's 3% under 10 million and 2% over 10 million. And we'll find you the best deal and fight every day with Steve to try and get you the best deal. So we're definitely on a different side of the equation than them. They have to satisfy their investors. We have to satisfy our borrowers. So it's a fight every single day, but unfortunately, until federal legalization comes or, safe banking passes, a lot of lenders are still avoiding this space. We just talked about it at lunch. If you're doing a $20 million deal in this space, there's 3 to 5 guys who you can go to, and all their money is expensive, because they have to satisfy their investor. So really, it's based on what you're borrowing and how much you need and how much equity you're able to raise as well.
So I'll just tack on to that as the lawyer, the non-finance person on the stage. So when I work with companies, so similar to Joe, we do it on both sides. So we work with a lot of the lenders on stage here, but also helping companies figure out strategizing, right? Given we know the cost of capital is high in this industry. So the way that I think is easiest to understand a lot of the time from the company side is how much do you need now, right? And it very much relates to Joe's point as to where you are in your life cycle. But how much do you need now? What is it going to cost? And how soon, what are you going to get in exchange for that money, right? What is the result going to be for your business that is going to make that cost worthwhile and then some? Right? And then on the company side, the better of a job you do getting gentlemen like these guys to see that picture and to believe you that by injecting this capital now at what we'd all agree is certainly going to be more expensive than any other industry, most likely, is going to be worthwhile because you are going to get paid back in X amount of time because this is what I am going to do with your money, right? So I think the more you can paint that picture and think through how long is this going to take before it becomes cost effective, and that helps balance out whether it's worthwhile or perhaps something worth waiting on, depending on whether you're, growing or still trying to get in the green and being prudent about when to take on those costs.
All right. So I'm going to be the pretend CFO, and I'm going to say you all are very, very expensive capital, and I don't want to pay it. And so part of the panel is timing. So I'm a smart CFO. I'm going to say I'm not going to pay this high cost of capital today, but I'm going to wait 6 or 9 months. I'm going to wait for Schedule 3 to drop. I'm going to wait for safer banking to pass. I'm going to wait for the Ohio rules to come out. Whatever those catalysts are, I'm going to wait for the Florida legislation because once that happens, my cost of capital, meaning what I could borrow from you all or execute a deal, is going to go down dramatically. What do you say to me?
I would say it depends on what you're using the money for. So, for example, if you're going to use the money for M&A and to acquire another company, although capital, maybe it's 25%, 50% more expensive than it was 18 months ago, I think that the valuations across the space are down 80, 90%. So it may not make sense to wait from a cost of capital perspective if you're trying to acquire now, because those same catalysts that will reduce the cost of capital are going to dramatically increase the cost of whatever you're trying to acquire. Whereas if you're like, hey, I want to go build out or acquire retail in a more mature market like Colorado or California, maybe it does make sense to wait for that cost of capital to come down.
Can you all hear me okay? So we don't have to do past the mic. Thank you. So let me challenge that. What I heard you say earlier was part of the cost of capital to the room is your cost of capital, the return you need to provide to your investors. So is what you're saying that 6 months, 9 months from now, your cost of capital is going down and so you can provide a lower rate?
It depends on how competitive the space is. I don't anticipate the cost of capital to drop as dramatically as other folks do. I mean, when you look at the debt maturity cliffs over the next 3 years, just for the top, call it 20 multi-state operators, I mean, you're talking about $2.5 billion plus. So the supply and demand of capital will still likely be in favor of the investor. So I'm not that confident that you're going to see some massive drop in the cost of capital. I mean, maybe 25% if rescheduling happens and everyone gets very excited and it's back in the.
That would be dramatic, 25%. I see, Michael, you seem like you want to add something to
Yeah,
this.
pass it.
And then as an astute CFO, I think you need to really choose your capital partner wisely. You got to find some value add with cost of capital as high as it is. You got to look at your business, know your margins, and understand the ROI you're going to get on taking that money. And then from there, whoever you're partnering with, they better do something beyond the money that they're giving you, because anyone can write a check that's really expensive. But are they going to do anything that helps you get into new states where you can get some synergies across their portfolio? So maybe you get some new brands launching in your production facility in a state where it's a lot more lucratively priced than maybe California is. There's a lot of factors, I think, that play into the cost of capital. And back to what we said before, it's definitely not a science.
All right, let me switch, unless you have something you want to add, Jesse?
Yeah, I mean, I think the answer to that question is very state specific, and it's all about opportunity cost, right? And if you have an opportunity in a certain state that's emerging, you should take that opportunity today, because as every lender on this panel will tell you, in 5 years from now, that market is not going to look the same. There's going to be compression. The price per pound wholesale is going to go down. We've seen it in every single market. So if you're in an emerging market and you're waiting for descheduling or waiting for, the rainy day that they actually approve this federally, you're losing out on an opportunity that's, in front of you today. So for us, I would tell our borrowers to move forward, get your business profitable, and we'll move you into a bank loan, or move you into a better cost of capital product, right? Our goal is to grow with you and get you the best product you qualify for. So if you are EBITDA positive, net income positive, you have assets, we can go to a bank and get you 10.5%, 11%, right? But a lot of the borrowers that we deal with in emerging markets don't have that. So they start with a more expensive loan, and then they graduate into something better. So really, it's all opportunity cost for us.
Yeah, I'll just add my 2 cents on this is I think this industry has been terrible about managing its own expectations around cost of capital coming down. I think many folks in this industry think the promised land is just around the corner. And I've had conversations over the years where people think they're going to be borrowing at 5-6% in just 12, 18, 24 months. And you can see the laughter. It's just not going to happen. With a 10-year up at 465 again, the risk premium over the 10-year for this sector isn't going to go down dramatically, in my opinion, even with a Schedule 3 or with SAFER. So I think the risk premium for the sector plus the risk-free rate are going to stay elevated for a while. And so I'm in the camp of take capital when it's available. All right, let's switch gears. There have been a number of restructurings and distress during 2023. There are additional maturities to come in 2024, not so much 20, little 24, 25, and then 26. What are the lessons learned that you'd share with the room from the restructurings you have either observed or you have participated in? Samantha, as the lawyer, let's get you first.
Well, I've never run into any sticky situations, so I don't really know what to. No, I'm just teasing. So on the company side, I think the most important thing is that you be transparent and upfront with your lenders. And there's obviously a fine line that you want to walk down with that, because you don't need to necessarily be overwhelming them or sharing every single detail without thought. You certainly want to be thoughtful in how you present certain things, particularly if it could be something concerning to the lenders. But if you wait too long, the second you burn that bridge or lose trust with your lender, it can absolutely be fatal. Because just like everyone on the stage, the people that are lending money in this industry are used to being in high-risk investments. And if they start to feel that they no longer have trust in the company, then they are going to behave differently, period. So I think most lenders in this industry are comfortable in understanding, for the reasons that everybody just said, the cost of capital, while it may come down, look at what's happening in the general markets right now. It would be naive to think that it's only cannabis, right? Like, everybody's a liquid. Cash is coming at a premium period right now. So I don't think that this industry is going to be immune to the larger challenges in the market, and lenders understand that. But you've got to be practical and you've got to be forthcoming. So by keeping the dialogue open and not being afraid to tell someone, there's a problem here, here's how we're going to deal with it, here's the plan, here's how long I think it's going to take to fix, and here's what I need. It's okay to make an ask. It's okay to say, you know what, I need a holiday on my payment this quarter, and here's why. And here's why it happened, here's why I didn't see it coming, and here's how we're going to fix it. That is a lot better situation to be in than simply waiting till the last day it's due, not making the payment, and then having a surprise lender on the other end. So I think being open and forthcoming, even when it's bad news, is crucial to avoid a messy restructuring.
Echo everything Samantha just said. Only thing I'll add, and it's kind of sacrilegious for a lender to say, is don't over-lever. Like, yes, time value and now, if you can have first mover advantage in the market, that's going to move mountains for your company, like, do it. But really dial in on that budget and don't take more debt than you need, because in a workout, like, the lender can only get what their credit agreement, like, entitles them to. And if you don't have, like, I don't know, you're not 3 or 4x levered on your business, it's going to be a lot easier for you to get out of that hole. Don't dig it any deeper for yourself. And yeah, I mean, even if equity markets are really expensive, having somebody to put some equity in your business, it could really, in the long run, pay dividends.
Just one thing I'll say about restructuring. Avoid messy capital stacks. What we find with a lot of borrowers is that when you have subordinated debt, regulators will often treat that like senior secured debt. So you have to have incredible attorneys like Sam here to really help you structure these deals so you actually can secure your collateral.
Any questions? I'd like to open it up. Questions for the crowd. We've got some more, but with 10 minutes left. Any brave souls have any questions that they're interested in learning about? Over here.
Does funding change if it's for the hemp industry or for
definitely.
What's that?
Definitely. We do a lot.
Good. Why don't you talk about it?
We do a lot of tradition. Yeah, does funding change for the hemp industry over cannabis? So you're not selling cannabis, right? It's a legal product, so it's much easier for us to finance it. We do traditional financing as well. We do term loans, SBA loans, line of credits. So really the benefit of working with us is that we can kind of pivot to some of those traditional products sometimes, right? Especially if the operator owns another business or if it's a hemp business, we can go the traditional route.
Can I just add one thing to that? So this wasn't directly your question, right? But so talking about how does hemp change the lending market, another thing to be mindful of is what are your core assets and what are you selling that's of value, particularly in the lending context, right? Because if you have not just hemp, what if you have real property, if you have what we would call a hard asset, right? A license is non-transferable. We all know that. That's a lot harder when it's part of your enterprise value. But depending on what type of property you own, for example, IP, maybe you can't obtain federal protection for your IP right now, but there are plenty of things that you can do on a state level that lenders will recognize as valuable. That creates value as well. So it's not just a matter of what's in the product you're selling, but it's really a matter of how you structure your business as a whole and how you can sell the most valuable, different pieces of that puzzle to create, and unlock the most attractive price capital.
And kind of just to add to that as well, for ancillary businesses, we finance, dispensary builders, insurance providers, all types of ancillary cannabis businesses. If a lot of your money and customers are plant-touching companies, then you're categorized as cannabis, right? And you're put into the cannabis bucket. But if you sell to other types of companies that are not plant touching, then it's a little bit easier.
Who else?
Do you think some of these Canadian companies that have these credit portfolios and MSOs here in America are going to be successful at working this whole thing out and being able to hold on to these assets, foreclose on them, and run them?
Good luck to them. So I think the question is, what are these the Canadian lenders going to do who have U.S. assets that are currently distressed and need to be restructured, or how are they going to go?
They have these credit portfolios and MSOs here, and now they're foreclosing on them. How they're trying to structure these deals, even though they're in Canada. How are they going to do this here? How are they going to hold on to these credits and foreclose and take the assets?
Yeah, so I think the question is really on foreclosing on assets in the cannabis industry. It's extremely difficult. The reality is, if you are foreclosing on an asset, that asset is already distressed, right? The asset has already been struggling. Cash flows are insufficient likely to service the debt, in which case now you have to go in and say, hey, I'm going to take your business away from you, and I'm going to run this business, or I'm going to put somebody in there. And when you're dealing in a highly regulated space, it takes a very long time to even get a judgment, a summary judgment, to go in and actually operate that business. So, if you're already bleeding cash and unable to satisfy your creditors, and you've got to wait a year to go through a legal process, and all the while the morale of that company, right, is like they had 100%, equity and tons of upside in their mind, to very, very little. What we find is the most optimal path through that is to actually cooperate with the operator and say, okay, you can have some equity upside, and let's do this together. Because the idea that you're going to come in and say, this is mine now, give me the keys, I don't see a lot of practicality to
And as you passed it down, I had 2 points to this. Number 1, structural, and then number 2, operational. So structurally, I think Iantis is a really good example of where you had a foreclosure process that took an elongated period of time because of the regulatory nature of the business, and the business was capital starved, as he was talking about. It was capital starved for a period, and some could argue that it stayed capital starved for too long. But then that leads you into the second point, which is execution. So can they do it? Sure they can do it, right? So separate the structural piece from the execution piece. The question will become, can they actually do what's necessary from a managerial perspective to put the businesses together and operate them profitably? So the table's set. It's a difficult lift, in my opinion, but the table's set for them to do it if they can execute.
Most of you know how hyper-local cannabis is. Like, if you have a grow, you better be in there 7 days a week. I mean, cannabis technology is coming a long ways, but it's a long distance from Canada down to whatever state they're trying to foreclose into to turn these things around. And especially the management team probably doesn't want to stay on if you just foreclosed on them. Sounds like a tough task.
We'll go over here and then we'll go over that.
Thank you. Let's say you're doing $1 million deal, and you're kind of on the fence, not to get cash flow positive company. What's your idea of PGs? Does it help? Does it matter? Everyone in a court trying to get the personal guarantees left on it. Do PGs help if you have a loan?
And before you go, I'm going to ask for quick answers so we can get to more questions. We're running out of
Yeah, PGs are required on all deals unless you're publicly traded or have a very complicated cap table. Even equipment financing, which is what he's kind of probably referring to, is 51% personal guarantees, right? And you have to have sufficient debt service coverage.
Question in the back with the hat?
Allmore doesn't require PGs, he said.
I've been advising in cannabis for 10 years, finding that it helps buy and sell assets in many markets. I've got 2 clients in the Midwest that have incredible cash flow. One's vertical, one's got 5 stores. They put expansion capital to their asset. How are you guys thinking of financing for companies that have that kind of cash flow, but don't want to?
We do it all the time, yeah. If they're EBITDA positive and can service debt, we can do it.
Yeah. Going back to the question about ancillary products and concentration within the cannabis space versus external, what is that ratio?
So in 2023, we were 70% to cannabis and 30% traditional. Now the numbers flip-flop. We're 70% traditional, 30% cannabis.
that because, you don't see more supply and traditional supply stepping into the space that
Yes. I mean, I just think that there's still such a large supply and demand imbalance in the space that even if new capital comes in, and we're also talking about rescheduling, which is really just a tax relief, so it's a benefit to free cash flow, but doesn't allow new institutions to come in like a safer banking might. When I was saying 25% decrease in the cost of capital, that's like the bull case. That's probably the most optimistic that you should likely be as an operator.
We got time for a couple more if there's any others. As you're thinking, I'll add to that question. No, I don't think you're going to see with rescheduling, it's like speeding. If I'm doing 100 miles an hour and the speed limit's 55, and I'm now doing 90 miles an hour going to Schedule 3, I'm still breaking the law. And few companies in this industry, I don't want to say none can, but few would be able to get through the FDA process and get licensed as to legally being able to sell cannabis. So I don't think that going to Schedule 3 all of a sudden brings in a couple of funds or a lot of money where they say, well, now it's safe to get back in the water. And I don't think safer banking does it either.
Yeah, actually, so to reinforce that point, when it goes to Schedule 3, from an institutional capital perspective, it is identically as illegal. There will be no companies that are Schedule 3 federally approved.
And then add 2023 to the mix. 2023, from a lending credit perspective, was a scary year for anybody that wants to come into this industry. And so new money is going to be really, really hesitant to do something. What they probably do is acquire a company on the panel and maybe give them some more money to do that. Any other questions?
I'm just going to, I wanted to add one thing, to the point earlier about the personal guarantee, just making sure you guys are awake. I think, just in case anyone couldn't hear, it's really interesting, right? Because you heard just even on this stage some really different perspectives, right? You have some folks saying PG absolutely going to be required. It definitely depends on the loan size. It depends on the company. It depends on the life cycle. And then you had Mike right here saying, I'm not going to require it, right? So my point with that is take away, there's a lot of variety. Even though this is a tough market, picking the right partner to work with based on where you're at, based on what your assets are, based on are you trying to grow through acquisitions, right? Each person on this stage has a really different profile with where they're willing to take the risk, where they're going to apply a premium, and how they might look at different potential value adds. So exploring the different opportunities and being mindful of seeing what's out there before you commit is really important.